But back to economy, and let's connect Indranil Sengupta, Chief Economist with Bank of America Merrill Lynch. Indranil, good morning. Thank you for joining us. A month ago, we were talking about the slowdown. Then it started biting us. Now it is haunting us. Are we in for a prolonged pain for next 2, 3, 4, 5, 6 months? Or it could be 12 months?
Well, I think the genesis of this slowdown lay in the liquidity crunch in 2018, largely because the RBI did not do OMO fast enough relative to FX sales. If you see from December onwards, the RBI has been pumping in liquidity proactively. If you see, the government has also taken measure after measure after measure to de-stress banks. So I think that we will probably see the turnaround somewhere around December. So I will say that what you are seeing now had its genesis in what happened about 8 months ago. The corrective measures started around December, January. So the impact will be felt probably in another 3 to 6 months' time.
Fair point. All eyes now are really on what's going to happen with the policy and our own MPC in Indranil, and the clamour is only now getting louder, especially given the kind of global shakiness that hope against hope that it's going to be a cut which is going to be deeper than 25 bips. What is it that you're expecting the MPC to do? Is it going to be 25 bips or something more than that, which would take the street by surprise?
We are looking at 35 bips. Several reasons why. Number one, the rains have improved. Number two, the global uncertainties have deepened following, the President Trump putting more tariffs, now China being called a currency manipulator and so on. Number three, we think that commodity prices are beginning to come down. Number four, the global rate cycle is turning with the Fed cutting 25 bips. We are looking at another 50 bips. Number five, we see inflation well within control. In July, we are looking at 3%, which is actually lower than June's 3.2%. And number six, we think that lending rates need to come down by October, because once the busy season sets in October, no bank is going to cut lending rates. So when you take a look at all these factors, we think that the RBI MPC will cut, 35 bips.
Just given the tight liquidity situation currently, the very slow transmission, and the fact that we're watching out, of course, for that 25 basis point this time, Indranil, do you feel there's a case building for a further series of cuts for the rest of the fiscal? What would you anticipate, given the commentary we're now hearing on how the slowdown could perhaps be a little bit more prolonged as well?
Liquidity is now actually easy. Okay. That's corrected from what was happening last year. Point is that we're looking at 50 basis points of cuts, further cuts above the 75 as our base case. But if the rains continue to improve, if the Met forecasts come right, we are looking at 75 basis points. That's going down to 5%.
Okay. Indranil, one side is we are talking about low interest rates. Low interest rates on paper can kickstart the economy. But some would argue that low interest rates are a necessary condition, not a sufficient condition. Economy will start when you feel like investing. Economy will start when you think your capital is safe. Economy will start when capital formation starts, when the corporates will start spending. And on that front, there is bad news. Every corporate we've spoken to, if you looked at companies like L&T and Thermax, which are lead indicators of capex, all of them are telling us that there is no good news on the private sector capex front. So even if rates come down, Indranil, some would argue that they may momentarily pick up the demand, but this is not going to fix the problem.
No, but then, until you bring down lending rates, demand is not going to revive. It's only after demand revives will capex revive. So, between lending rates coming down, demand reviving and capex picking up, there will at least be a lag of 1 to 2 years. Now, you will never get to the revival of capex unless you cut lending rates. After, say, 1 to 2 years.
Fair point. Do you worry about where the corporate sector spending is moving? Because frankly, the sense which I am getting from some of the good corporates and big corporates is that half the corporate world does not have the ability to do capex, and the other half who has the ability is not willing to do the capex. So what is the solution in sight for this?
No, that's precisely the point, that if you cut lending rates, demand revives, then the ones which can do capex will do capex. The ones which don't have the funds will get the funds to do capex. So the first thing is that you have to see revival of demand. You can't have capex without revival of demand.
Okay.
Right. But Indranil, one could debate about how much the rate cut is going to be, what kind of transmission would it lead to the system or not. But the fact of the matter is, we've been debating on a daily basis, the animal spirits are yet to come back. Do you think a rate cut, if it is on expected lines, according to you, 35 bips, that would really revive the animal spirits in any which way? Or would it be at best just a very temporary leg up?
No, I mean, we've had 75 bips of rate cuts. Of course, we had a 50 bip hike before that. So effectively, we have cut only 25 bips. Now, this 25 bips plus 50 to 75 bips should be enough to, roll down lending rates. And then, as demand picks up, animal spirits are going to pick up. So, all I'm trying to say is that there is a 1 to 2 year lag between lending rates coming down and, investment happening. In between, first demand has to pick up. It's only when people actually see demand pick up that they're going to, increase their capacity. You are not going to add to capacity if half of your factory is lying idle.
Just to wrap it up, we started with a view on economy. We spoke about interest rates. We are talking about private sector capex. Hand over heart. Now, there is no way in which scientifically we can measure it. This is just my personal thought. I was saying in the morning that every time we've seen a crisis in the past, whether it was your twin deficit issue in 2013, Lehman Brothers, or successive problems before that, every time the country is pushed into a corner, I have seen that policymakers, they go out of the way to fix it. So do you think the current state of economy is nothing short of a crisis? And now soon there is admission coming from the government, and soon action will come forward, because that's how India works. I mean, there's crisis, there's late admission, and then there is a solution.
Well, I will say that, if you look at what, the RBI has done since December, if you look at what the MOF is doing since then, you will see that, there are at least 10, 12 measures that have been taken. Whether it is rate cuts, whether it is providing liquidity, whether it is recapitalizing banks, rationalizing the bankruptcy code, rationalizing the PCA framework, removing the additional CRAR, creating pre-NCLT structures, I could go on and on. So there are a huge number of measures which have come since December, but then all of them will take time. These things, it's easy to get into a liquidity crunch. It's much tougher to get out of a liquidity crunch. But then, like I'm saying, that all these measures that are being taken from December, the fact that the fiscal deficit was maintained at 3.3% of GDP, all these measures will probably bear fruit in the coming months. At the same time, the risk factor is that there are obviously global risks which are rising. But domestically, I would say that, there is a huge number of measures which are being taken, every month, every week.
Indranil, thanks so much for joining us this morning and for sharing your perspective.